Hello everyone, welcome to chapter 2 and 3. These two chapters will be explained together in this single video. Now, this chapter is about key levels and integrating key levels with market profiles, right? Now, I've already explained what market profiles are and what are the different intricacies of market profiles, but now we're going to take that even further and add another concept, which is the concept of key levels and PD arrays. We're going to combine that with market profiles and refine our understanding even further. Now, the way how this is gonna work is that first of all, I'll explain each concept individually and then I'll teach you how you could combine and integrate these concepts with each other and use them cohesively to produce or generate trade ideas. Now, we've already explained what market profiles are in chapter 1, and if you haven't watched chapter 1, then you should first of all make sure to watch that first and then continue with this chapter. Because the way how these chapters have been designed is that they are step by step, right? I'm coaching and teaching you them in an organized, proper manner, and every single chapter is connected with each other, right? So if you haven't watched the prior chapters, then you wouldn't understand the later ones. That's how it works. Now, before we get into the chapter, I just want to point out and address something. There's some of you have been making some really good notes of these chapters and breakdowns that I'm sharing with you. And I was really overwhelmed by the positive reviews and responses. So let me tell you this, that this is just the inception and there's a lot of stuff ahead of us that you'd really enjoy. Now, as I said before, these theories and technical knowledge in these chapters is all fun and games, and it develops and refine your understanding. But what you also need to know is that you need to see some live application of these concepts, right, in the markets, and how you can use them to find trade ideas and how you can execute them, right? That's why you also need to make sure to properly watch and learn from these trade breakdown videos that I share with you as well. Because without those videos, you won't know how you can use it in live markets, and those videos show you life application of this theory of this technical knowledge, which is one of the key aspect in learning a theory or concept or anything, right? All right, now let's get into the chapter. So, key levels. The basic definition of a key level is basically important price points, areas or zones or whatever you want to call it on the price chart where significant expansions and reversals occur, right? Now, this is the basic definition of what a key level is, and it can be broadened and refined even more. But for the time being and for the sake of efficiency, we are just going to deal with this definition at the moment because it's the most accurate one and the most understandable one. Now, key levels have certain characteristics, right? They can serve as areas for potential CRT to be formed. They can serve as zones for potential expansion profiles and the reversal profiles to occur. They can serve as catalyst, or you could say a reactant for expansions to occur, right? They can be used as confluences for your trade ideas, meaning if you found a potential trade idea and it has a key level as a factor, then you can potentially regard that idea as a high quality trade or an A plus setup. But similarly, if it doesn't have any key level as a confluence, then you can respectively manage your risk on those sort of trades and trade them accordingly. So you can see how you can use key levels to manage your risk, right? Not only you've used key levels to find high probability trades, but you can also use it to manage your risk based off of it, right? That's why it has so much significance, and almost all of my entries are based off of key levels and never alone. Now, last but not least, you can use key levels to frame trade ideas based on the above factors, right? These were some of the characteristics of key levels. Now, the reason why I explained them to you is so that you know what you're going to be dealing with in this chapter and you're going to be ready for what's ahead of us in this video, right? Now, this key level concept is going to breed a new life in your understanding and is going to refine your understanding of market profiles even more. Now, these key levels are referred to by multiple names, right? Some call them PD arrays, some call them precursors, some call them even point of interest or POI, and I myself call them key levels, right? Now, the name itself doesn't matter. What matters is the theory and the technical significance behind it. You could call it whatever you want or whatever you like, but for the sake of our understanding and for the sake of efficiency and pattern recognition, we all are going to refer to them together as key levels, right, instead of any other name. So that way, if we are discussing key levels, it would be more easy for us to break down, explain, and relate to, right? Now, let's discuss some important and relevant key levels here. Now, Some of the most important ones are the following. The first one, and my favorite one, is the order block. Now, order blocks have a proper and rational logic and narrative behind it, right? There's a proper logic behind how order blocks are formed and how you can use them as key levels. The reason why order block is my favorite key level is due to the fact that order blocks are one of the most objective and least objective key levels. And there's a proper way of how can you choose and select an order block, right? Now there's a hierarchy of key levels from least significance to more significance. And in that hierarchy, order blocks are the most important ones and work the best every time if you properly integrate it with market profiles, right? Now, the second one is the breaker block, which is also a really good key level and you can use it to frame trade ideas. Now, each one of these key levels have a proper logic and narrative behind how they are formed, how they can be used. And I'm going to discuss them later in the video, but for now, let me just give you a brief introduction today. The third one is an FEG. Now, an FEG is basically just a lower time frame turtle soup or a higher time frame CRT, but for the sake of efficiency, as I said, which is the main aspect of CPI, which is efficiency, we're just gonna call it and refer to as an FEG, right? The next one we've got on the list, a really important one, a rejection block. This is also a form of an order block, but it's an extreme one and it lies on the extreme ends of an expansion swing and ranges, right? And when chosen correctly, it offers really good trade ideas. Now, last but not least, the two most important key levels after an order block, which are highs and lows. Now, if I had to only choose two key levels for my trading, then I'd choose order blocks, highs and lows. These are the only two key levels I use most of the time in my trade ideas. I barely use breakers or FVGs. Most of my trade ideas are based around either order blocks, highs or lows. Now, there are many key levels like mitigation blocks, propulsion blocks, liquidity voids, opening gaps, and much more, but they're mostly just to create noise and distraction. And in my respective opinion, you don't need them. I don't even use them myself, right? I only use the one that I've mentioned in this list right here. What you need to learn about and master is these key levels right here, right? I've chosen these particular one intentionally because that's what have worked for me and have worked for other students of mine, and those will work for you as well. If you add in a other key level in there, it's just gonna add more variables to your understanding and it's gonna create confusion for you and you wouldn't know which one to choose and select. That's why I'm gonna explain only these important ones to you that I use myself, right? Trading is mostly about having a balanced and appropriate approach. If you don't have enough knowledge, then obviously you don't have a chance at succeeding. But at the same time, if you learn every single concept out there and use every single concept that there exists, then it's going to create so much confusion for you that you're going to end up being a victim of analysis paralysis, right? And you wouldn't be able to analyze the charts properly with a balanced perspective, right? That's why technical knowledge is important, but only when it's balanced and doesn't end up on either of the extremes, right? This is exactly how these chapters have been designed. I could talk for hours on these things right here, but that won't help you as much as if I explain them in detail efficiently and tell you what's right and what's wrong right away, instead of going sideways around it and being indirect like most so-called gurus and mentors, right? I'm going to be completely straight and direct with you and only explain the things that I know are important for your understanding. Now, you could probably guess someone's technical knowledge and expertise just by listening to them talk about it, right? You could straight away point out or guess if someone is actually really about it or they're just clowns who don't know what they're talking about and here just for a quick buck, right? You can straight away find convictions in someone's teaching just by listening to them. My job here is to make sure I tell you about the right thing straight away and be direct and straightforward with you instead of being a diplomatic political dickhead who just want to avoid controversy and discussions and always tries the safe approach. Now, obviously, I've learned these things myself from other people like Romeo, and it's not like I was born with it, but the thing is that I added my own touch in it through research and backtesting and experience, right? And that's exactly how you can succeed in trading. If you're just being a copy paster and not adding your own touch to it, then it's not going to end up good for you. but also you need to remember that it's something you need to do once you learn everything, and then backtest and research every single concept, and not now, because your job at the moment is to master this stuff and add your own touch after you complete and finish CPI and gather the appropriate amount of experience and intuition that it needs, right? Because everyone has their own way of looking at things and approaching things, and everyone has a different mindset and perspective, and everyone has a different taste, a different emotional and rational thinking, right? So you need to do a self evaluation and then choose the style that suits you the best, and not anyone else but only you. Now let me explain to you what an order block is, right? So the most refined definition of an order block that I could find is this one. This is Romeo's definition of an order block, and it's the most refined and accurate one I could find. So here's the definition. The candle that ducks above a high or ducks below a low when engulfed, when that candle is engulfed, is considered an order block, right? Now here in this picture right here, you can see we've got this low right here, and what happened is that price came down here to turtle soup this low and take out that low. Now for an order block to be considered a valid one, it must have a turtle soup and must be formed after a turtle soup. If there is no turtle soup, the order block won't be considered correct, right? Now here you can see this is the exact candle that dug below this low right here. That means now we're gonna wait for this candle to be engulfed. And what I mean by engulfed is for price to close above it. And once price closes above it, it will become a valid order block for us, right? Now you can see right here price closed above that candle and formed this order block, this big bulky candle which became an order block. After that, we're gonna wait for price to retest this order block, find support there, and then expand from there. And this is what we call an order block. After an order block is tested, price is gonna expand from there and take out the opposing end of the range. Now let's discuss breaker blocks, right? So the definition of a breaker block is the following: the high that takes out a low, or the low that takes out a high when broken and retested, is known as a breaker block. Now in the hierarchy of key levels, breaker block is in the mid range, right? In the mid range of significance, but it's an important key level that you could use on the higher time frame. Now you can see right here that we've got this high and this low right here, and what happened is that this high took out and turtle souped this low, and then it got broken above after that, and after that it became a breaker block. Now we're gonna wait for it to be retested and find support there, and we're gonna expand from there. Now you could use the opposite to see how a bearish breaker looks, right, or a bearish order block looks. Now how about I give you a homework here, right? What you should do is show me how a bearish breaker block and a bearish order block look. I've already shown you a bullish one, and you should go on your chart and find a bearish one on the chart and show it to me, right? All right, now let's talk about an FEG. Now one thing you need to remember is that if you know about turtle soup, then all of these key levels will be really easy for you to understand and get a hold of. We've already discussed what order blocks and breaker blocks are, and you saw there that the only reason they were considered valid and correct were due to the fact that it had a turtle soup before them, right? Now, even when it comes to an FEG, it's just basically a lower time frame turtle soup. And if you look at a higher time frame FEG on the lower time frame, then it's just gonna basically look like a lower time frame turtle soup, as I said. Now, the definition of an FEG is basically is a price gap between consecutive candles which suggest an imbalance in price action. But as I said before, it's basically a lower time frame turtle soup and a retracement profile. Now, let's move on to the most important key levels, which are highs and lows. Now, highs and lows are some of the most important key levels in the hierarchy, and they have the top spot. And if you look at the charts, then you would see that most of the expansions and reversals occur around significant highs and lows, and they're basically the key things and the key factor that moves the market, right? During a reversal profile, what happens is price swoops above a high and then it reverses straight away. Similarly, if even during expansion, Price first of all takes out a low or a high and then takes liquidity before it continues, right? Now let's get into another slide. Okay, so here we got a chart, right? And on this chart, we're going to explain the anatomy of a price swing or a swing, right? So this is ideally how the market moves. Now it's not going to look sweet and short like this, but basically on an objective and mechanical level, these are the phases in a price swing, and this is what we also refer to as the sequence or TSQ as well. So what happens is that a price swing starts when the price takes out a significant low or a high. And in this case, we've got this low right here, and price swooped that low and it swooped it with this candle right here. Now, based on the definition of an order block, when such candle is engulfed, it becomes what? It becomes an order block. And here you can see the price closed above that candle that dug below the low, and it became an order block, a valid order block. After that, what happens is price retests it and expands from there. Similarly, when price is Similarly, when price closes above the high that broke the low, it becomes what? It becomes a breaker block. And then price tests that breaker block, finds support there and expands from there and continue its price swing. Then at the end, the way how price swing ends is also by a turtle soup. So price swing starts with a turtle soup and ends with a turtle soup, right? And once that ends, it then start another swing through those mechanics and dynamics. This is basically ideally how the market moves and swings. And you're gonna find this mechanic in every price swing. They might have variable looks, but the core concept will be the same, which is this one right here. Now that was it for key levels in chapter 2. Now we're going to move on to chapter 3. In chapter 3, we're going to discuss how we can use key levels and integrate it with market profiles to expect and anticipate expansion and reversals with a high accuracy and precision, right? This is one of the most important chapter till now, and you should carefully watch this one and make as much note as you possibly can. We're going to be using proper rational and sound logic to profile price on the charts in conjunction with key levels. Similarly, we're going to see what are the different combination and different outcomes for key levels and market profiles when combined with each other. Now, the integration of profiles and key levels would act as a major filter for us to avoid lower probability market condition. Now, our job as a trader is to only trade high probability and high quality trades throughout the week, which only form like 2 to 3 times, and the rest of the time our job and our objective is avoiding lower probability condition and waiting for our setups patiently, right? Now you've heard it from me before and I'll say it again. The important part about trading is waiting for your setup. And more than 90% no more than 90% of the time, all you would be doing is just waiting patiently for your setup to form, and then you're gonna execute it. And that doesn't take that much of your time. Most of your time is spent on waiting on the charts and not doing anything stupid in between trades. And that's where market profiling and key levels come in, right? That's where you would need a filter that could make you avoid lower probability conditions. If you didn't have a filter, then all you'd be doing is trading every sort of market condition, and that wouldn't be profitable for you or work out for you. So most of the time you wait and then you execute only in high probability condition. So market profiles and key levels together will give you filters. Similarly, you're going to avoid trading certain combinations of market profiles and key levels and trade others, right? Now, last but not least, we're going to use these two together to expect or anticipate other market profiles, right? These are the main things that we're going to be learning in this chapter. Now, the first combination we've got here is the combination of ranging market profile and key levels, right? Now, what you need to keep in mind is this line right here represents key levels on the higher time frame, okay? So whenever you see this dotted line right here, it would represent a key level on the higher time frame. Now, there are only two possible outcomes or two possible combinations or scenarios we can have based on this combination of ranging profile and key level. The first one is when price forms a range and the ranging profile ends without testing a key level, right? Now, this key level could be in the form of an order block, a breaker block, or maybe a high and a low, right? That doesn't matter, right? What matters is the logic behind it. Now the first scenario is when price forms a range above a key level, and you can see it right here that the ranging profile has ended without any key level tested, and that key level isn't tested in the ranging profile, right? So in that case, we're going to expect what? We're going to expect a manipulation profile to form, and that manipulation profile will test that key level. And once that key level is tested during the manipulation profile and that ends, right, we're going to wait for that manipulation profile to end, and then the only profile we can expect after a manipulation profile is what? Is an expansion profile in the opposite direction, right? So that was the first scenario we can have based on combination of ranging profile and key levels. On the other hand, the second scenario is when price forms the range inside a key level, meaning the key level has already been tested inside the ranging profile, and in that case the market profile that we're going to expect is an expansion profile without any manipulation profile in between, right? Now, and the other one we expected a manipulation profile because, as I said, the key level was untested, and price first had to test a key level as a catalyst for it to expand higher. That's why we expected a manipulation profile. But in this case, we already have tested a key level in the ranging profile, so there is no need for a manipulation to occur. Here we can straight away expect an expansion profile, right? So you're seeing that we are using a proper sound logic here, and we aren't pattern trading it, right? You see that we are using if and then logic, right? So these were the combination of ranging profiles and key level. Now we're going to discuss another combination. Now let's discuss the combinations of expansion profiles and key levels. Now what you need to know is that this chapter right here that we're discussing is related to the first one. So first of all, you should watch that one first, so that way you know what are the different possible outcomes for price after a certain market profile ends, right? So right here you can see that the first scenario based on the combination of expansion profile and key levels is when the expansion profile ends inside the key level, meaning we've tested the key level in the expansion move. And in that case, we're going to expect a reversal profile straight away because a key level has already been tested, and that key level is going to act as a catalyst for expansion in the form of a reversal profile. Now, based on the first chapter, we learned that the only outcomes after an expansion profiles are a ranging profile, a retracement profile, and a reversal profile. Now that we've combined it with key levels, we can see that we can cross out the ranging and retracement profile and only expect a reversal profile in this case because a key level has been tested, right? So you can see that we are adding filters to our understanding and our understanding of market profiles. So before we could have expected 3 possible outcomes, and now we brought it down to a single one based on market profiling and key levels, right? Now the second scenario is when the expansion profile ends before it tests a key level, and in that case we're going to expect a reversal profile. We're not going to expect a reversal profile straight away because a key level hasn't yet been tested. So in this case, what we're going to expect, that we're going to expect either a retracement profile or a ranging profile. In this case, we got a ranging profile, and then we go back again to the first combination of ranging profile and key levels. And in this case, ranging profile hasn't tested the key level. So what we're going to expect? We're going to expect a manipulation profile, right? So that a key level is tested, and then after that we're going to expect an expansion. So you can see here we are using again proper logic and sound logic to expect or anticipate market profiles based on the combination of profiling and key levels. If the expansion profile has tested key level in the form of if the expansion profile has tested key level in the form of an order block or breaker block or whatever, then we're going to expect a reversal profile straight away. But if it hasn't tested any key levels, then we're going to expect a ranging profile, and then use the same logic over and over again to expect other profiles and profiles the market. Now the third scenario is when expansion profile doesn't test a key level, but then after it has a retracement profile, and then after that retracement profile we can expect another expansion towards that key level, right? Now in this case the second expansion has now tested a key level, so what we're going to expect? We're going to expect a reversal profile, right? Because that expansion profile has tested a key level, right? Are you liking it so far? Now let's move on to the another combination of market profiles and key levels, and that is the combination of reversal profiles and key levels, right? Now in this case we've got two key levels right here, one above and one below. Now first of all you can see that we were inside of our range, and then we had an expansion profile, and that expansion profile tested a key level. So what we're gonna do, we're gonna expect and anticipate a reversal profile straight away. In this case that reversal profile ends, and then it ends inside a key level, right? You can see that this reversal profile has ended inside a key level. So in that case we can expect a range to form there, because the reversal profile has now ended, and now we can expect a range to form to cap the price swing. Similarly, in scenario 2, the reversal profile ends without testing a key level. So that in that case we're going to expect what? We're going to expect a retracement profile to form, because a key level hasn't been tested yet, and the drawn liquidity is still in play and still above, which is the key level above. And we're going to expect first a retracement profile and then an expansion higher again, right? So these were the combinations and outcomes we can have when integrating reversal profile and key levels. Now let's discuss some more intricacies and details of market profiles and key levels. Okay, so first of all, as I said before, this integration of market profiles and key level is gonna be used as a filter for us to expect certain outcomes and avoid certain combinations, right? Now we're gonna only trade expansions and reversal profile, as I said in chapter 1, and we're gonna avoid trading retracement profile, manipulation profile, and ranging profile. Now you can trade these profiles too, and I'll teach them to you in later months, but for the sake of efficiency and for the sake of time being, what you need to remember is that only to trade expansions and reversal, because those are the only profiles that offers the most accurate and precise price swings, right? So for example, if a manipulation profile ends, then you can trade the next profile, because you know that the only possible outcome after a manipulation profile is an expansion, and you can trade that expansion, right? Similarly, if an expansion profile ends inside a key level, then you can trade the next profile too, because you know that after an expansion profile ends inside a key level, you can expect a reversal profile there, and you can take a reversal trade there. That's how you're going to be anticipating market profiles and trading them. Now let's discuss some combinations and outcomes of market profiles again, right? So here we got a format, right? The first variable in this equation represents the last profile that has ended, and the second variable represents a presence of a key level and whether a key level has been tested or not, or whether it's present or not, right? And then combining them together gives us a possible outcome, which is the constant of this equation. So here in this way we can see that if the last profile that has ended is an expansion profile, and it ends before testing a key level, and a key level hasn't been tested yet, and a key level isn't present, then we're gonna expect what? We're gonna expect either a retracement or ranging profile, and we're gonna avoid trading them, because we only trade what? We only trade expansion and reversal profiles. Similarly, if the expansion profile has ended inside a key level and a key level is present there, then we're going to expect a reversal profile there. And as I said before, we're going to trade that because it's a reversal profile. Similarly, we've got other combinations below as well that can potentially refine your understanding even further, right? Now, these aren't the only combination. We've got others too, but these are the most important one, and you must note them down and remember them to improve your understanding. Now let's move on to another slide, right? Now here I'd be giving you a proper framework around time frame selection and how you can integrate market profiles with key levels. And what you need to know is that you won't be using the same time frame for both concepts. You'd be using higher time frame for finding key levels, and then the lower time frames for profiling in market profile. You'd be using time frame alignment for deciding the different times for both, right? Down here you can see some combinations of time frame alignments and how you can use them. So if you're an entry trader, then you're gonna be using the 4 hour for finding key levels, and the 15-minute for profiling the market. Similarly, for scalping, M15 or the 15-minute time frame is going to be used for key levels, and the 1-minute time frame is going to be used for profiling. This is the framework that you're going to be using to integrate key levels with market profiles in a logical manner. My objective in CPI here is to teach you how to use all of these concepts in a logical manner instead of looking at it with a perspective that is predominantly based on patterns, right? Yes, I know that patterns don't work, and what work in this market is logic and narrative, and this is what I'm teaching you at the moment, and this is what I taught you so far. Alright, let's get into the charts now, and let me explain market profiles and key levels to you on them, right? Now, as I said before, we're going to be using time frame element to decide our time frames, and as I'm an intraday trader, that's why I'm going to be using time frame element and using 4 hour to find my key levels, and then I'm going to be using the 15-minute to find to market profile for market profiling. So the 4 hour for finding key levels, and then the 15-minute for market profiling, and that's how we're going to integrate them with each other, right? Now I'm gonna study in this now we're gonna study and discuss the price action of the last 3 to 4 days, and we're gonna see how we could have used market profiles and key levels to potentially trade that price action, and how you could have seen it with a different perspective than what you have right now currently, right? So we're gonna obviously start off with key opening times right here, and you know that the daily candle opens and closes during the 17 Eastern time or the 5 p.m. Eastern time. So we're gonna start off with right here, and right here you can see that we could use a key level either in the form of an order block, right? We can use them order block, we could use a breaker block, an FVG, or a high and low, right? These are the key levels that we can use and find on the 4 hour to integrate it with market profiles and potentially generate trade ideas, right? Now this right here you can see that on Wednesday what happened is that we had this expansion below, right? These 3 consecutive down candles expanded below, and it did what? It took out this swing low right here, this 4 hour swing low right here. Now we're gonna look at the price action on the intraday charts and see how we could have used market profiles to trade it, right? Now, as I said in the first chapter, after price opens right here at 17 Eastern time or 5 p.m. Eastern time, right, it straight away goes into what? It goes into a ranging profile, and that's exactly what happened here. Price opened right here, and it straight away went into a ranging profile. And the reason why price straight away goes into a ranging profile is due to the fact that the Asian range starts, and on the major currencies like euro and pound dollar, the liquidity is quite low at that time, and the algorithm tends to range during that time, right? Then after that ranging profile ends, what we have is that we have this expansion right here after a ranging profile ends. Then we have this kind of small retracement down here, but after that retracement ends, we have this another huge expansion. And with this expansion right here, what we did is we also closed inside a key level, and this expansion move tested a key level, and this expansion profile ended inside a key level. And based on what I've taught you so far in the video, after an expansion profile ends inside a key level and tests a key level, the next profile that we can expect is what? We can expect a reversal profile straight away, and that's exactly what happened here. You can see that after this expansion ended inside this key level, we reversed from here, and price straight away went into a reversal profile, right? You could have traded this reversal profile and this reversal expansion right here based on this factor right here. So we match this 4 hour key level in the form of this low right here with this market profile in the form of an expansion, and expected this reversal right here. Now we're gonna move on to the next day and see how we could have traded that, right? Now on Thursday we can see right here that on Wednesday we had taken out this low. Now after price takes out a low, the next target for us becomes the opposing end of the range, right? So if price takes out one side of the range, we're gonna then take out the another side of the range. And so here's the 50% of the range, and here we got this side, and then the opposing end of the range is this one right here. So based on range trading and range profile, I'm going to teach you this in the later chapters, and we're going to see that after price takes out one side of the range, then our drawn liquidity becomes 50% of the range, and then the opposing end of the range. This is how basically range trading works in a nutshell, right? We're going to learn about them, and we still have to learn a lot before we move on to the other chapters. And I can assure you that you're going to learn this in the most accurate way possible. But first, let's get in the chapter and discuss how we could have traded this price action right here, right? Now, on Thursday, what happened is that obviously we already had taken out this low on Wednesday, and price went straight into a reversal profile right here. Now on Thursday, and also as I said that we've got this key level right here is a drawn liquidity and as a key level for us to punish a trade or market profile, right? Now you can see that again price opened right here and went straight away into a reversal profile, into a ranging profile, sorry. So after price open right here, it straight away went into a ranging profile, right? And then after ranging profile, it had an expansion. Then we have this retracement right here, and after a retracement profile ends, the only possible outcome we can have is an expansion higher, and we had this expansion right here, right? Now the unique thing in the what can we say, the unique thing about this expansion profile is that it also took out this range high, right? This range high and swing high in the which is our 4-hour key level, and this expansion profile ended inside a key level and tested a key level. So what that means is now you can expect what? You can expect a reversal profile, right? And that's exactly what happened. After price with this expansion tested this key level right here, this 4-hour range high, and closed inside of it and tested it in this expansion, we're now gonna expect a reversal profile from here. Now if let's say if price hadn't closed inside that key level and hadn't took out that high right here, for example like this, and the expansion profile had ended there, then we would have expected a range and then a manipulation and then an expansion down. But in this case the expansion profile tested the key level, so we then straight away expected a reversal profile from here, right? Now this is the Friday's price action right here. Now this is a homework for you, and you should study it on the 4-hour and the 15-minute. Tell me how you could have traded it with market profiles, and how you could have integrated market profiles on the 15-minute and key levels on the 4-hour to have a unique and a dynamic and a mechanical and objective perspective, right? This is a homework for you. You should send it to me. Now let me discuss this price action right here as well, right? Now let's remove all of this right here. So we've got this range low, this range high, but also this range high as well, right? Now this is Monday right here, and price opened with this huge opening gap right here, and it opened after this 17 Eastern time or 5 p.m. Eastern time, right? Now again, based on the same logic as I said before in the first chapter, price straight away goes into what? It goes into a ranging profile. And then after ranging profile, it has one possible outcome, which is an expansion or a manipulation. In this case we had an expansion, right? Now the unique thing about this expansion again is that with this expansion, what we did is we took out another key level, which is in the form of this 4-hour swing high or range high, and this expansion tested a key level. So after that, what can we expect? We can expect a reversal, right? So you can see here that we are using proper logic here. We started with the range, then an expansion, then this expansion tested a key level, and after that expansion profile ended, we had a reversal profile, right? This is how you could use market profiles and key levels and integrate them with each other to have a dynamic, objective, and a unique perspective of the charts. And you're going to be using time frame alignment for that.